Hi, this is Brandon Bischoff with Canterbury Investment Management, bringing you this week's Canterbury Market Update for the week of January the 13th, 2020. So starting with the market state, the S&P 500 remains in a bullish market state with low volatility. Again, low volatility is a sign of low risk in the markets, whereas higher increasing volatility would be a sign of higher risk in the markets. Canterbury Volatility Index currently measures CVI 45, and volatility remains extremely low. We've mentioned in previous updates how volatility below the level of 45, similar to the squeezing down of a spring, you could see an outlier day, no telling when that'll occur or what kind of impact it'll have. In other words, will the outlier day be up or will it be on the downside? But regardless, volatility does remain low, which is again a sign of a more low risk environment. So the S&P 500 is actually currently kind of leading most market indexes with the exception of the NASDAQ. And the S&P is largely made up of large cap growth and large cap value. It is a large cap index, and as we sort of pointed out last week, it's primarily made up of technology stocks, which as shown in the NASDAQ have seen a lot of strength recently. So that helps kind of explain why the S&P has been so strong. But if we look at the market's return for the year, which has again been really less than 2 weeks, we can actually see that large cap growth and actually mid cap growth have had a really strong start to the year. And actually some indexes are actually down to begin the year. Again, it's not that big of a deal. We've only been in the markets here for 2020 for the last week and a half or so. But if we kind of go back to our volatility weighted relative strength rankings, which Canterbury uses to sort of put different assets and securities on an even playing field by adjusting their strength for their volatility, we can see that large cap growth and large cap value are currently leading the market, which was a characteristic we saw pretty much all of last year. And if we look at small cap value and mid cap value, those are kind of in last of all those different rankings. So there's a lot more growth at the top, and the large caps are pretty much beating everything on a risk adjusted basis. We can also use the volatility weighted relative strength ranking to look at different asset classes. How do we compare, sectors to bonds or, international equities to the dollar? And if we actually look at those rankings, we just selected a couple different indexes here. If we look at U.S. large caps, which will represent using the S&P 500, they are in first. We just talked about the strength that they've had last year and kind of start off this year. Gold is actually in second. Gold's been doing pretty well. And then we have international developed emerging markets. Investment grade bonds, corporate bonds, are actually the leading bond index. And then at the bottom you can see is the US dollar, which has been struggling as of recently. But on a risk adjusted basis, US stocks and gold are sort of showing the most strength out of those asset classes. Canterbury Portfolio Thermostat currently has an efficiency score of 100, which is considered efficient. Volatility is around 30, benefit of diversification is about 38%, which is right in range with where you want to be during a bullish market environment. We do hold positions such as gold we mentioned was showing strength, and then as far as another alternative, we do have those those investment grade corporate bonds, which are one of the leading bond indexes. But that brings us to the end of this week's Canterbury Update. We look forward to talking with you next week.